Today we're talking about SCHD, the Charles Schwab US Dividend Equity ETF. If you haven't heard of it before, you've been living under the rock probably. And so far year to date, this thing is down about 11.90%. So down a bit, but actually doing a bit better than the overall market is doing. And then the other one we're talking about today is DGRO, the iShares Core Dividend Growth ETF. And actually this one is down year to date so far for the year, 9.95%, so it's actually doing a bit better than SCHD has been doing. We're also going to talk about a mystery ETF that may actually be better than both of them. I'm not going to give it away yet. You're going to have to wait until a little bit later in this video. Let's start by comparing these two ETFs. First off, we have the expense ratio. We have a net expense ratio for SCHD, 0.06%, DGRO. We have 0.08%. They're very, very much the same, okay? If it comes down to the fact that they're so good, they're so similar, then we need to pick one, maybe we'll do it based on the expense ratio, but we're not going to get there yet. So let's talk next about the dividend yield because, of course, most of you watching this video, you care about the dividends that these things spit out. For SCHD, we have a dividend yield for the 30-day SEC dividend yield. We have a 3.79%, DGRO only with a 2.30%. So the Schwab ETF is actually paying a lot more in dividends than DGRO is, so that might be very important to you to understand and to know. And by the way, these do both pay quarterly dividends, so that's something you also might need to know in case you do want to have something that does pay monthly. These two do not, they pay quarterly. SCHD has $35.2 billion in assets under management. DGRO has $21.2 billion, so both very big ETFs. SCHD has a lot less holdings in it, 104 holdings, and then we have DGRO with 417. It's a much wider portfolio for DGRO. In terms of the top 10 holdings, we have, for example, let's go for the first 5, let's say. We have Merck for SCHD, Amgen, IBM, Pepsi, and we have Pfizer. And then DGRO, we got JP Morgan Chase, Microsoft, Johnson & Johnson, and we got Apple, and we have Pfizer in there. So a little bit of overlap here. We are going to look at the fund overlap in a second. So there are 54 overlapping holdings in these ETFs. So 13.1% of DGRO's 413 holdings in SCHD, and 55.1% of SCHD's top 10 100 holdings are in DGRO. We talked a little bit already about what's going on with the different sectors, but this kind of actually shows us visually a bit better. As you can see, financials are a little bit more skewed towards DGRO, and then tech is a little bit more skewed towards SCHD. Now, when we're looking at the big differences here, we have healthcare for DGRO, and then we have energy for SCHD. Let's talk returns. So we have blue and yellow here. So the blue is going to be SCHD with a 5-year return of 73,000. Oh my gosh, I wish. 73.33%. And then we have DGRO with about 61.14% return. So DGRO has done a little bit less in terms of return over this time period. Now, okay, let's talk about if we go back before the pre-pandemic, because things get a little interesting when you go back a bit. And I do want to ask you a question here. Okay, so everyone loves SCHD so much. And why? Well, it pays good yield, obviously, but it's because it's done so well in a capital appreciation standpoint as well. Now, when you go back and you look at these before the pandemic, which of these would you actually like more? If you're really only wanting something that has decent yield, but also good capital appreciation, well, DGRO outperformed SCHD during this time period, this 5-year time period, and 79.60% versus 66.33%. So DGRO actually outperformed back then. When we look at these ETFs and we're always like, hey, which one's the best? Most people, they just say, okay, well, what are we looking at until today? Which one's done the best over this longest period of time? Okay, SCHD has been the one that's doing the best right now. But it's not always the case because different environments, different things going on. I mean, things can change when it comes to the returns of different ETFs, and that's just how it goes. Sometimes it's going to be a good environment for a specific type of ETF based on the methodology it uses to find stocks. Sometimes it's going to be out of favor, and that's kind of the way it goes. And as you invest long enough, you kind of start realizing these things. So, okay, let's talk about the mystery ETF. Here we go. Here is the mystery ETF. It does have a lower return than the other two. We got 59.8% versus DGRO, 61% versus SCHD, 73%. And you're probably looking at me and saying, Robbie, look, I mean, what are you throwing this at us for? I mean, this thing does not do as well. And by the way, I should mention that these are all with reinvesting dividends, by the way, these returns are. So let me tell you why this might be an interesting one to compare here. Okay, so I want you to tell me what you think is interesting in this yield box, okay? What do you think is interesting? I'm actually in a room by myself. That's kind of a weird question to ask. So I'll tell you what I think is interesting. It's not this, but it's this. Monthly dividend payments, monthly yield. There's a lot of people in this world that want to have that, and they can't have it because they're investing in SCHD, or for whatever reason, they're investing in stocks that don't give yield, of course, every single month, which some stocks do, but not all do. So there you go. You can get monthly dividend income if you want that, if you're retired or if you're getting close to retirement, if you're financially retired, financial independence, retire early, any of these things, that could be a great benefit for you. So that's something that you might want to, just think about at least, because it does also have a dividend yield of 3.9% for the shorter term dividend yield. And then it's higher than SCHD's dividend yield and a lot higher than DGRO's dividend yield. Just as something that I'm saying, just saying, people, just saying, something to think about. If there is something that you're not going to like, it's actually probably the expense ratio, unfortunately. So we have a net expense ratio of 0.36%, and actually the gross expense ratio is a little bit larger, so they're probably giving you some type of like rebate type thing. Not rebate, that's not probably the right word to use, but they're giving you some, if they're not doing some type of marketing type of things in mutual funds, it's called 12B1 fee. So if they're not doing these things, you're probably getting some money back, and you're basically going to get a little lower expense ratio. Not 100% sure. This is based on Charles Schwab, so maybe Schwab even has an error here. Not 100% sure. Usually ETFs are pretty much the same gross and net expense ratio. Anyway, okay. So before we drive that nail into the coffin here, let's do a little quick thing. I do want to talk about the standard deviation of these ETFs and look at this interesting factoid that we have here. Imagine you invested $100,000 into SCHD. It grows to $212,000. If you go back until, let's say, the very start of 2015 until today, $212,000. Hey, I like it. I like it. So you have iShares, you have the DGRO ETF, $201,000, just a little bit less. And then you have the CDC ETF, $202,000, so a little bit more than DGRO, a little less, of course, $10,000 less than SCHD. But look at this, standard deviation, 13.5%. This is the risk, let's say, that is inherent inside the ETF over this time period, right? This was the standard deviation. Okay, so SCHD standard deviation, pretty, I'd say significantly higher. Of course, not crazy high, but it's definitely higher. So that's just an interesting little factoid I think that we should talk about. So a little bit less risk, a little bit less return, better yield, at least over the past 30 days, and pays monthly. Just something to kind of bring to your attention if you want to look at it or something like that. Of course, SCHD, it's always a baller ETF. It's going to be a great ETF. DGRO, it's in its own right, is pretty good too. Of course, the yield's not as good, but it does have decent capital appreciation as well. So that's all I got for this video. Disclaimer right here. Watch another video coming up on the end screen. See you next time.